So you're new to the startup world or you're new finance leader and you don't really know what fundraising is or equity fundraising is. Well, today I wanted to take you through what fundraising is and then also some fundraising terms that are used quite regularly. So kind of like a glossary so you know what everyone's talking about. Hi, my name is Alysha Randall and I am a fractional CFO, and I also train new and aspiring CFOs within startups and scale-ups. So if it sounds like you, please do hit the subscribe button so you will get these weekly updates in all the time. And as I said, this week I am going to talk about fundraising, like an introductory guide to fundraising and fundraising terms. So if you're new into the startup world, you may already be aware that particularly with startups and scale-ups, fundraising is a big part of the business model, and it's also a big part of the finance leader's role. So you really do need to understand fundraising. There is debt fundraising and equity fundraising. Debt's obviously getting a loan. There's elements of equity fundraising that is relevant for debt fundraising. Debt fundraising is sometimes a bit less involved and it can take up to 3 months, whereas equity fundraising can take sometimes up to 12 months. So it's definitely a bigger process and there's a lot more involved, largely because the investors are taking on more risk, whereas with debt they are as well, but they're getting a repayment. So essentially what fundraising is generally with a startup or scale up, they need cash to help develop new products, develop new services, build the team, enter new markets, grow the business with sales and marketing. And so in order to be able to do that, the business needs to raise monies and look for investors to get the capital, get the cash to fuel this business growth. So generally when they're doing a fundraise, it could come from different sources. So there will be private investors, angels, high net worth individuals, venture capitalists, which is generally a fund managed by a venture capitalist and they have lots of investors within that fund, or private equity firms, also known as family offices. And if you haven't ever done fundraising before, then obviously need to understand kind of the basics of that and also some terms that you need to know. So generally raising capital from external investors, they're raised to hit those specific goals. So again, whether that's developing the product. So at that early stage, you may be looking for angel investors because you've got an idea of a product, but you need some funding to actually develop that product. You also may want to get fundraising for new products at a later stage. So you may have a core product already and you need funding to create additional products for your customers or new customers, or you may want to enhance or improve the existing product, particularly when we're talking about technology. So there may be a product that's working really well, but you need fundraising to enhance that. A perfect example of that is when I worked for Love Firm back in the early 2000s. They had a product that sounds crazy now, but they used to send DVDs through the post to subscribers. Now, obviously, the technology was moving in the direction that it is today. And so Love Film needed fundraising or needed to do a fundraise and find investors to help develop the digital platform that is now the Amazon Prime UK platform, or in the early stages it was. So there may be need for investors to develop products throughout the life cycle. There's also expanding operations. So whether that is for increasing the growth within the existing market, so the business may already be in the UK, but most of their customers are in London or maybe not regional, but it may be a certain sector and they just want to grow it. So generally that's through sales and marketing. So whether that's a sales team or marketing acquisition costs in order to find more customers. Or it might be entering to new markets. So whether that's entering new markets as in there's a new channel or they want to do some M&A, so acquire other businesses that can work with their existing customers, or internationalization. So, for example, the UK business wanting to launch into the US or vice versa. So it's really important to understand what the fundraising is for. It's not just about getting monies and just to help with working cash flow. It really is to think about what the strategic goals are for the business, how much or how you're going to get there. So the steps from an operational point of view, and then what does that look like from a financial point of view. So it's no different to doing a regular budget. You obviously would have a strategic goal of the business, the operational goals, and then create a budget off the back of that and make sure they're financially sound. In this case, it's dreaming a bit bigger and working out how much cash you would need in order to fill that gap. So the key players in fundraising really does include VCs, so venture capitalists, private equity firms, angel investors, crowdfunding platforms, and all of these groups of investors essentially provide funds in exchange for equity or other financial returns. So there are a few different equity instruments, and a few of them I'll touch on when we go through the fundraising terms, but they're not just giving you cash for nothing, that they're investing in the business. So you can think about it like the stock exchange. You would invest in a company for the share or stocks in the business. It's exactly the same thing. It's just a private market rather than a public market like the stock exchange. Okay, so common fundraising terms for beginners in the fundraising space. So the first one is equity fundraising, and this basically refers to that process of raising capital or raising cash by selling shares in the company. So it is the most common form of fundraising for startups and scale-ups. And during this equity fundraising, investors essentially get a percentage of ownership in the company in exchange for their investment. So it may be 1%, maybe 5%, might be 0.5%, might be 20%, which is quite a big one. 20% or more is quite material. So there will be a conversation with the existing investors and the founders pre-fundraise of how much they are wanting to raise, and therefore how much of the business these new investors will get. Private equity financing. So private equity really refers to investments made by a firm or investors directly in private companies. So therefore, these PE firms are not listed on this stock exchange. So private equity investors, they generally are looking to acquire a controlling stake so that they can influence the operations and grow value before selling it for a profit. So they're quite sophisticated investors. You can potentially, it may be an exit scenario. We'll go through exit shortly, but they are very sophisticated investors. You would generally want to already have product market fit before you speak to a PE firm, and have a good understanding of what the customers want, why they like you, recurring revenues, how big the market is, all those kinds of things. So that would be a PE firm. Venture capitalist or VC fundraising is when it's raising funds from VC firms. So these firms, they also provide capital early stage. VC firms generally have an understanding of at what stage they want to invest in, but also what industry. So again, they will give cash to the business in exchange for an equity stake in the business. And VC funding usually occurs in different stages. So you have that initial stage, family and friend stage, and angel investors at that very early stage. Then you have seed, then Series A, Series B, Series C, etc. So VCs, some of them will want to invest at seed Series A. Some of them will only invest from Series A onwards. Some of them will only invest in Series B onwards. So, and that's largely to do with how much risk they're willing to give, but also how much cash. So usually further along that the raise is, a Series B raise, for example, will be much bigger than a seed raise. So the venture capitalists will have an understanding of how much risk they're willing to take, but also how much cash they're willing to have available to invest in various businesses. Okay, the next term is a term sheet. So a term sheet is non-binding agreement. So even if you've received a term sheet from an investor, they can still walk away. But essentially it outlines the key terms and conditions of the investment that the investor is willing to take. So it basically is really the starting point of the legal documentation that will follow once the investment is fully agreed. So the term sheet will include things such as the valuation of the company, the amount of equity that they're willing to invest in your business, and the investor rights. So if an investor is showing interest in the business and there's further conversations happening, it's best not to get too excited until a term sheet has been received. So there's plenty of times that investors will spend a lot of time looking at your business and asking for lots of information and then never deliver a term sheet and never invest. So it really is worthwhile considering who potentially is a time waster and who is going to give you a term sheet. So if somebody says they're going to invest, I wouldn't get too excited again until a term sheet has been received. The next term is dilution. So this is when a company raises new capital by issuing new shares, and therefore the ownership percentage of a shareholder will decrease. And this is essentially called dilution. So it's really understanding that every time there's a fundraise, how much dilution will affect the founders and the early investors. And often as a finance leader, you need to do that analysis, what that looks like. So a very super easy example is, say you have two founders, they both own 50% each, and then they decide to bring in an investor who wants to invest 33% of the company. Then all three of them will have 33%. So two founders will go from 50% ownership to 33% ownership. That's your dilution. When you're doing a fundraise, we're talking about many more shareholders. So it's doing that calculation of pre and post monies. Convertible loan note. So sometimes when there is an equity round, a convertible loan note is used rather than just using shares to be invested. So convertible loan note is also called a CLN, and this is a short-term debt investment that converts into equity in a future equity fundraising. So sometimes it's a popular choice for investors who want to either delay putting a valuation on the company until it raises a significant round, but it's also less risky than just buying shares up front. So sometimes a CLN is used in between larger rounds by existing investors, like a top-up round. So essentially, they're giving £100,000 in cash or dollars in cash, whatever the amount is, and which can be converted into equity in a future round at a discount, it's the benefit, or converted into debt, and then it's just treated like a loan. So this is one instrument that you may see during for a short equity. I did talk about CLNs and convertible loan notes in much more detail. I'll link that above and below. The next one is cap table, otherwise capitalization table. And this is generally a detailed spreadsheet, or you can use a cap table software these days, which is much better than having it in a spreadsheet, but early days it might be a spreadsheet that basically outlines who owns what. So it lists all the investors, the types of shares they hold, and how much of the company they own. So it will say how many shares they own, what type it is, or options or warrants or whatever it is. This needs to be kept updated every single round. And this is what you would use to calculate the dilution as well. So you would say, okay, this is the cap table that we have today. Here are all the shareholders. This is how many shares they own each, and this is the percentage ownership. And then if, say, we do a £10 million raise between, say, 3 new investors and 10 existing investors or shareholders, this is what the cap table would look like in the future, and then the percentage ownership would then change. So that is what a cap table is. The next one is cash runway. This is something that you would consider thinking about when you are looking at cash anyway, when you're doing cash forecasting, but it is a metric that needs to be understood as part of the fundraising. Again, I do talk about KPIs for startups and scale ups in a lot more detail. I'll link this above and below as well. So this really does say how many months before the company runs out of cash, and understanding how much runway is quite important when preparing for a fundraise, because it really then helps determine the urgency and the timing of the next fundraising. So it may be worthwhile having a conversation with the founder when the cash runway is, but also ideally you want 12 to 18 months of cash runway before starting a fundraise process. And this is because a fundraise can take up to 12 months before you receive any cash. And then also it may take a couple of months for the cash to be actually received in the bank account. So you need to allow enough time in your fundraising process so that the business doesn't run out of cash and the fundraise is an urgent request. It's much harder to negotiate terms when you've only got a short runway. You basically would have to accept unfavorable terms in order to get the cash in. And then the final term I wanted to go through was exit strategy. So investors will always want to know how long they'll have to wait before they get a return on the investment. So an exit strategy is generally one of two or three, but generally two. And it's when the business is acquired by another company, or there's an IPO, an initial public offering, and it gets listed on the stock exchange. There can be a buyback of shares. So this is when the business gets to a large profitability, the founders decide they want to buy the shares back from all the investors. So there is that option as well for investors, but often the two exit strategies that founders are considering is an acquisition or an IPO. So this is when all the investors will get their money back, and hopefully at 10x, if not more, of what they initially put in. So it's worthwhile understanding that. Again, I did talk about what a finance leader's role is in fundraising. So again, I'll leave details for that above and below. But essentially, the main role for a finance leader is to get the numbers right, make sure that everything is accurate and transparent and aligned with the company story. A due diligence, there is often a financial due diligence as part of the fundraise, either pre or post term sheet. So you need to make sure that you're ready for a due diligence so that you can be ready for that. You also need to prepare a data room with all the necessary documentations. Again, I've talked about data room before, so another link for those. And then finally, the pitch deck. So you will need to contribute to the pitch deck, but it's also worthwhile you reading it as an investor and challenging the business on whether the pitch deck is good enough. Again, I've already done a pitch deck video, so I'll leave that above and below. Obviously, because I talk about startups and scale-ups all the time and being a finance leader, and fundraising is such a big part of this role, there are a lot of resources, free resources available for you that you can access so that you can get that high-level understanding of what it means to be a fundraise. It can be quite an intimidating process, so you do need to have the right knowledge and preparation, and hopefully you can navigate that effectively. If you want assistance on that, you may want to have a look at our Financial Leadership Fundamentals course. It is 12 modules, and I can say right now, all of them talk about fundraising within it. So it's preparing early stage, getting through a fundraise process, and then what do you do after a fundraise process and manage all the investors. So if that is something that you might consider, feel free to book a discovery call with me, and I'll leave a link for the course below. It's really important that you understand this, because fundraising does affect all aspects of your role as a finance leader within a startup and scale up. So that's a lot of information and a lot of links to more information, but that should give you a good high-level overview of what fundraising is, what it's all about, and all of the terms that you need to be mindful of. Again, if you are a new or aspiring finance leader within a startup and scale up, please do hit subscribe and leave any questions below so we can take a look at those. So otherwise, I'll see you in next week's video. Cheers.